Welcome back to part 3 of the best cryptocurrency trading course for beginners. In this week, we're going to be talking all about indicators. Now, something that you should know, the sad reality is that the vast majority of indicators are completely BS. I mean, they have no predictive ability to actually tell you what's likely to happen with price in the future. However, there are a couple indicators that actually do have some sort of edge, and I want to show you how to use them in this course. Again, my purpose in making this course was to make it free and to make it better than the ones that some people charge thousands of dollars for. So if you're getting value out of this so far, then go ahead and like, subscribe, and turn on the post notifications so you don't miss next week's episode. We're going to be talking all about trading systems. Now, up until this point, we've covered crypto basics, we've covered charting, and we're going to cover indicators today. Now, next week, make sure that you stay tuned because we're actually going to be covering trading systems. We're going to start putting all this foundational knowledge that you've learned together, and then we'll cover our favorite trading strategies and trading psychology. Okay, with that being said, part 3, we're going to be talking all about indicators. Okay, we're going to talk about 5 different common indicators that are our favorite indicators to use, and these are really the only 5 indicators that you need to use. So first things first, we're going to talk about moving averages. So moving averages are likely the most common indicator that there is. And essentially what a moving average is it's a average of the price over a certain period of time. And it's represented by lines that look like this. So here's how to put it onto your chart. You'll just come up here to indicators and then you can put on moving average, and you can see that there is a moving average and there's a moving average exponential. So there's 2 types of moving averages. One is a simple moving average and one is an exponential moving average. I like to use an exponential moving average, and all it does is it simply assigns a higher value or more weight to what's happened to price more recently. So once you put the exponential moving average on, you can change the settings here by changing the length. So this 10 period would mean that it'll take into account the 10 previous periods, the price in the 10 previous periods, and it will plot it that way. So it's always plotting 10 periods previous, and that's how the average actually works. So I put that on here. You can see it in blue here. This is what's called the fast moving average. Generally, you'll use 2 different moving averages in conjunction with one another, one fast and one slow. So you can see I've also included this 50 period moving average, which as you can see is a little bit smoother. This is called the slower moving average of the 2. Okay. Now, again, you can just come in here to the settings and you can change this to whatever length that you'd like to. In this case, I'm using the 10 and the 50. Now, a couple things about moving averages. You can see that a lot of the times moving averages act as like a support and resistance. You can see that price kind of bounces off. You saw it bounce down here to the 50 moving average. It bounces off. So it kind of acts as like a dynamic support and resistance. Now, generally, how you'll want to trade moving averages is you'll trade the crosses. For example, if you see this blue fast moving average cutting above this slow moving average down here below, this is a signal that you want to buy or get into a trade. And then you can just trade and get out of the trade once these cross again. Okay, this is a very simple way. Okay, and then right here, we'd want to actually sell, and we'd trade and would sell because the blue line has crossed under the orange line. Okay, and then we'd exit the trade like right here. Okay, so this is the idea behind moving average trading. You can also use it. You can see if you're in an uptrend, if the market pulls back and it comes back to this moving average and it looks like it's starting to pull away, this is also a good way to know when you could get into a trade in a trend. The next indicator that we're going to talk about is called Bollinger Bands. So to put on Bollinger Bands, you can just come up here to the indicators. You can type in Bollinger Bands and you can just click it and you put it on right here. Now I've already have the Bollinger Bands on here, but you can change the style of it if you want to make it thicker or if you want to make it a different color. You just come in here, you could change the color and you could make it thicker, but this looks pretty easy to tell. So the Bollinger Bands basically gives you a volatility range that we can see that price kind of moves in and out of. So the way that you can trade Bollinger Bands is, for example, you could use it in conjunction with something like moving averages, right? To get an idea of which way the trend is moving. And then once it comes down to the lower band, this could be like an entry point and you can ride the trade up until the next band. So just for example, we could see that price hit the band kind of right here and we saw that it pulling away. So we can enter the trade once it comes off of this lower Bollinger Band and we could trade it up until this next Bollinger Band zone, which is right here. This next band, the higher band here, or the upper band right here. Okay, so in a trend, you can see that it kind of plays off of this lower band and then it pops up to the upper band, right? So you can easily just trade it by simply buying into this lower band and then getting out of the trade when it hits the upper band. The next indicator that we're going to talk about is the relative strength index, or also the RSI. So the RSI is what's known as an oscillator, meaning that the indicator oscillates between like 0 and 100 on this scale, as you can see here. And basically what the RSI does is it tells us when an asset is likely to be oversold and overbought. So in order to put this onto your chart, you can just come in here and you can type in RSI and you click it on there, and there you have it. Now, with the RSI, you can change what you want the upper band and the lower band to be. Generally, it's 70 and 30, or if you want to be more extreme, it's 80 and 20 you can use as the inputs, but 70 and 30 should just be fine. Again, if it's over the 70 mark, then this is what's called overbought area. And if it's below this 30, this means that this is like oversold area. So generally, you want to be looking to sell when it's overbought, and you want to be looking to buy when it's oversold. So generally, you want to trade in the direction of the trend, and then you could use something like the RSI to tell you when might be a good entry point. So just for example here, we see that we're in an uptrend. We see that the RSI was oversold. So we want to wait until it comes back above this 30 line, and then we can buy here. Okay. And generally you want to use this in conjunction with the trend. So if it's an uptrend, then you want to wait for something's oversold and you want to buy in there. Now, the next indicator that we're going to talk about is something called the SGA, or the Spiral Guide Algorithm, and this happens to be my favorite. The SGA, or the Spiral Guide Algorithm, was actually a proprietary algorithm that was put together by a gentleman named Lee Ryder, who's a partner of mine that's been trading since Bitcoin was 1 penny, believe it or not. And he put together this proprietary algorithm. To put it on your chart, you just come in here and you can type in the SGA and you can see it right here. Now, you will need to be a member of ours in order to access this indicator, but I want to show you why it's really, really powerful. And again, you can try this out risk-free. Go to our website. You can try it out for 30 days. If you're not happy with it for whatever reason, just let us know. We'll give you all your money back. But the reason why I like this so much is because it makes trading really easy. And as you can see here, it's basically these two lines, this gray and this color line. And then there's this histogram. And we'll talk about both of these, but essentially, this makes it really easy to trade. So you can trade it when it's green as a point where you'd want to buy, and you'd want to exit when it turns red. Okay, or you could sell even when it turns red. But again, the idea behind this algorithm is to capture these big tail moves. So again, here we saw a big downwards move. So you would enter a sell position here and you'd ride it all the way down till it turns green again, like right around here. Okay, and that's the idea. The idea behind this is to cut your losers short and to let your winners run long. And the cool part about this is we've done extensive back testing on this, and it actually has a real proven edge in the market, unlike a lot of indicators, which everybody's using. And the reason why they lose their edge is because everyone's looking at it, everyone's using that. So what's different about this is that there's not that many people using it. So it still has a really awesome edge, and it makes trading really, really easy. Now, the last indicator that we're going to be talking about is something called divergence. And I absolutely love divergence because unlike most indicators, which are lagging indicators, divergence is actually a leading indicator, which means it gives an insight as to what could actually happen with price in the future, instead of most indicators, which are lagging, which is telling what happened with price in the past. So how does divergence work? How divergence works is pretty simple. Basically, it means that when you see a discrepancy, what's happening in the price chart and what's happening in your oscillator. So here I have the SGA as well as the RSI because you can use it on either. But here on price, we see price making higher and higher, right? But if we look at what's actually happening with the oscillator, we can see that price is making lower bumps. So essentially, this means that price is kind of running out of steam, and we can expect that there may be a rollover of price, which is exactly how my partner Lee, who created this algorithm, the SGA, this is how he predicted the market top in 2017, as well as the market bottom in 2018. Now, let me show you how this would look on the RSI. Okay, same thing. You see price moving upwards, but we saw it right here. We saw this moving moving downwards. So this is a sign that basically price is moving upwards, but it's running out of steam, as we can see on this oscillator, which is in terms meaning that there could be a reversal happening soon. Now, also, we were able to predict this little local bottom here with Bitcoin because we saw divergence in the opposite way. So we saw price moving lower and lower just like this, but we saw the oscillator moving upwards like this. So this means that price is running out of steam on the downwards direction because there's a discrepancy. What's happening on the price chart is opposite to what's happening on the oscillator. We can see it in the same thing with the RSI. We saw price moving downwards like this, and we can see price moving upwards like this. So this is a sign that there could be a reversal. Now, one thing that I really like about the SGA also is that it can actually spot divergence for you. So you just come into the SGA and you go to inputs and you can put on the divergence positive and negative right here, and then it'll take a second and it will actually just spot the divergence for you. So give it just a second. Okay, and there you can see it. You can see that the SGA automatically spots divergence for you, which is a really handy tool. We can see it just like I spotted out earlier. We can see that it just shows it to you right on the chart, which is really, really nice. So now, how do you use these indicators in conjunction? Well, you can use them in conjunction. Say, for example, you want to use something like the moving averages to get an idea of which direction the market's actually heading. You can use something like the Bollinger Bands to give you a good idea of when might be a good time to enter. You could also use something like the RSI, which in fact will tell you when a market is overbought or oversold. And you can use the SGA, or you could just use the SGA by itself, right? Which kind of factors in all these different things into one. And you can also use something called divergence, which is a great tool, which is a leading indicator that'll give you some good insight to what's happened to price in the future. So with that being said, make sure that you like, subscribe, and turn on post notifications so that way you don't miss next week's video, because next week we're going to be building a trading system. We're going to be talking about all of the different components that make up a sound trading system. So make sure that you stay tuned for next week's video.